Stop. Before you sell, before you panic, before you make the same mistake 90% of people always make, listen to this. Bitcoin isn't crashing. You are. Today is February 10th, 2026, and if you feel sick watching that red ticker bleed, that's not market volatility. That's psychological pressure doing its job. You've been trained for this moment. Trained to doubt. Trained to fold. Trained to hand over your assets right when discomfort peaks. You think the $126,000 high was a fluke? That's not your thought. That thought was planted. You think getting out now is being smart? That's not logic. That's fear wearing a suit. Over the next 4 sessions, I'm going to show you how this move was engineered, who profits from your panic, and why this exact emotional moment is where wealth quietly changes hands, away from people like you, and toward people who never feel what you're feeling right now. You see, the market doesn't move because of news. It moves because of liquidity. And right now, the institutions are thirsty. They spent all of 2025 watching you get rich from the sidelines, and now they've decided it's their turn. But for them to buy at the price they want, they need a blood in the streets event. They need you to be so terrified that you hand over your digital gold just to make the pain stop. This is not a financial event. It is a psychological colonization of your mind. We are currently witnessing Bitcoin trading at roughly $64,000 to $67,000. It has halved from its peak. $2 trillion, let that number sink in, $2 trillion of global crypto wealth has been vaporized since October. The mainstream media is calling it a transition, a reset, or capitulation mode. But what they aren't telling you is who is standing on the other side of your sell order. Let's talk about the Warsh Shock. This is the primary narrative being shoved down your throat right now. President Trump has nominated Kevin Warsh to lead the Federal Reserve. The media story is simple. Warsh is a hawk. He wants to shrink the Fed's balance sheet. He wants to tighten liquidity. And because Bitcoin has spent the last decade acting as a sponge for excess liquidity, the experts say Bitcoin is finished. Bloomberg, Reuters, and CNBC are all singing the same song. They say that because Warsh might not provide the oxygen of quantitative easing, the speculative fire of crypto must go out. It's a perfect linear story. It's also a total lie. Wall Street loves a boogeyman. They needed a reason to shake out the leveraged longs that piled in during the 2025 rally. They used the Warsh nomination as a tactical catalyst to trigger a massive liquidation event. On February 5th alone, we saw $1 billion in Bitcoin positions wiped out in 24 hours. Was that retail selling? No, that was a coordinated strike. Kevin Warsh is a supporter of Bitcoin as an important asset. Michael Saylor himself called him the first pro-Bitcoin chairman of the Federal Reserve. So why is the price dropping on the news of a pro-Bitcoin nominee? Because the market makers know that the fear of a hawk is more profitable than the reality of one. They are using the ghost of 1980s interest rate policy to scare a 2026 generation out of a digital solution. While the headlines scream about hawkish Fed policy, the fundamental reality of the U.S. debt hasn't changed. We are still adding $1 trillion to the national debt every 100 days. No matter who sits in that chair, they cannot stop the debasement of the dollar without collapsing the entire banking system. They are gaslighting you. They are using the nomination to create a value zone for themselves. They want you to believe that the Trump pump is over, while they quietly build the infrastructure for the next leg up to $150,000. Look at the carnage in the corporate world. Strategy, the company formerly known as MicroStrategy, is seeing its stock hammered. They are underwater on their recent purchases. Mining firms like Riot and Metaplanet are down double digits. The experts are laughing, saying the Bitcoin treasury model has failed. But ask yourself, is Michael Saylor selling? Are the sovereign wealth funds in the Middle East selling? No. They are absorbing the hit because they understand time preference. They know that $64,000 Bitcoin is a gift when the global debt to GDP ratio is at terminal levels. The selling you see right now is forced liquidation. It is the sound of traders who gambled with money they didn't have being ushered out of the room so the real owners can take their seats. This brings us to the liquidity engine. In February 2026, the market is no longer watching a halving clock. It is watching the Fed's dot plot. We have moved from the retail era to the macro era. Bitcoin is now a $1.5 trillion asset. Moving the needle now requires institutional capital, the kind of capital that doesn't buy when things are green and easy. They buy when there is blood. They buy when the RSI is at record lows, levels we haven't seen since the depths of 2023. This is a tactical tug of war. On one side, you have the panicked retail investor who bought at $100,000 and is watching their life savings melt. On the other side, you have the cold-blooded accumulator who has been waiting for this exact $60,000 test to fill their CME gaps. The mainstream media wants you to focus on the price. I want you to focus on the signal. The signal is that Bitcoin's hash rate is still at all-time highs. The network is more secure than it has ever been. Favorable regulations have been signed into law. The SEC is no longer a hostile entity. We have a pro-Bitcoin president and a pro-Bitcoin Fed nominee. If you told a Bitcoin holder in 2022 that we would have all of this and the price would be only $64,000, they would have called it the greatest buying opportunity in history. But because you are living through the volatility, you can't see the forest for the trees. You are being price actioned into submission. Every time the Fed speaks, every time there's a new jobs report or an inflation print, the vultures circle. They use high-frequency trading algorithms to hunt your stop losses. They know exactly where the pain point is for the average American investor. They know that at $60,000, the psychological dam breaks. That is where they want to catch your coins. They are playing vulture investing. It's the practice of buying assets from people who are in a state of terminal panic. By hitting market sell today, you are essentially subsidizing the wealth of a billionaire fund manager who is laughing at your lack of conviction. You are handing over your seat on the life raft because someone told you the raft was too heavy. We are entering the great decoupling. This isn't just about Bitcoin, it's about the end of the 1913 Federal Reserve era. The system is trying to disrupt Bitcoin before Bitcoin disrupts the system. They are fighting for control of the narrative. They want you to view Bitcoin as a speculative tech stock that follows the NASDAQ. But Bitcoin isn't a company. It doesn't have a CEO. It doesn't have a marketing department. It is a mathematical certainty in a world of political lies. When you sell because of a Fed nominee, you are saying you trust a politician more than you trust the code of 21 million. Is that the bet you want to make? In this first session, we have uncovered the smokescreen. We have identified the vultures. We have recognized the psychological trap. But identifying the trap is only half the battle. To survive 2026, you need to understand the Exchange Mirage. You need to know where the coins are actually going when they leave the exchanges, because while the price is going down, the supply is vanishing. In the next part of this script, we will dive into the on-chain reality that contradicts everything you see on the news. We will look at why the exchange reserves are at a 5-year low, and why the biggest whales in history are currently in a quiet accumulation phase while you are being told to run for your life. Do not move. Do not sell. Do not let the vultures win. We are just getting started. The data is on our side. The math is on our side. The only thing that isn't on your side is your own nervous system. It's time to take control back. It's time to go beast mode. Welcome back. If you've made it this far, your mind is starting to clear. You've recognized the smokescreen of the Warsh Shock, and you've identified the vultures. Now we need to address the biggest lie in the financial world today, the price. When you look at your phone and see Bitcoin struggling at $68,500, you see a massive red candle and you think everyone is selling. But I'm going to tell you something that will change the way you look at a chart forever. The price you see on an exchange is not the value of Bitcoin. It is merely the price of the last paper claim traded between two speculators. In 2026, the paper-to-physical divorce we saw in the silver and gold markets has officially infected Bitcoin. For every one actual Bitcoin held in a cold wallet, there are now an estimated 30 paper Bitcoins being traded on futures markets, leverage platforms, and shadow exchanges. When the price crashes, it's often just paper liquidating paper. It's a ghost fight. Think about the Exchange Mirage. Look at the data from February 10th, 2026. While the media has been screaming about a crypto winter and a $1.6 trillion market cap wipeout, the total number of Bitcoins held on centralized exchanges like Binance, Coinbase, and Kraken has plummeted to a level not seen in half a decade. This is a massive, historic anomaly. Usually, when a price crashes, people rush to send their coins to exchanges to sell. That's how a bear market works. But right now, the opposite is happening. People are pulling their coins off exchanges at a record pace. According to recent Binance Square reports, stablecoin reserves are high, but actual Bitcoin liquidity is bone dry. If the supply on exchanges is disappearing while the price is going down, what does that tell you? It tells you that the selling pressure is artificial. It's a short ladder attack orchestrated by institutional desks to create the illusion of a mass exit. They are selling paper contracts to each other to drive the spot price down while simultaneously using their dark pools to buy the actual physical Bitcoin from you, the panicked retail seller. They are emptying the shelves while telling you the product is worthless. While you're worried about your portfolio being down 40% from the October highs, sovereign nations are playing a different game. In 2026, we've moved past the MicroStrategy era. We are now in the sovereign accumulation era. Rumors are swirling in the whale-watching community about massive, nameless buyers out of Abu Dhabi and Oslo. Norway's sovereign wealth fund recently disclosed an 83% boost in its Bitcoin holdings, taking its total to over 11,400 BTC. Abu Dhabi's Mubadala is no longer just curious. They are holding millions of shares in BlackRock's IBIT. These aren't traders. These are black hole wallets. Once Bitcoin goes in, it never comes out. Why would a sovereign wealth fund buy when the Fed is being hawkish? Because they don't care about Kevin Warsh's next press conference. They care about the great decoupling. They see the US dollar being used as a weapon, and they want an insurance policy that no Western government can freeze or seize. By selling today, you aren't just selling to a richer guy in New York. You are literally handing your seat on the future global financial life raft to a foreign government. Every Satoshi you surrender at 68K is a Satoshi that your children will have to rent back from a central bank in 2040. Let's look at the institutional buy signals that are currently flashing neon green. As of yesterday, February 9th, 2026, Bernstein reiterated their $150,000 price target. They called this the weakest Bitcoin bear case in history. Why? Because none of the systemic failures of 2022 exist today. There is no FTX, there is no Celsius, there is no hidden leverage. Instead, we have the iShares Bitcoin Trust, IBIT, holding over 770,000 BTC, nearly 4% of the entire circulating supply. BlackRock isn't in the business of losing money. They are in the business of collecting assets. They are currently watching you panic so they can fulfill their ETF mandates at the lowest possible cost basis. In fact, Bitwise predicts that in 2026, ETFs will purchase more than 100% of the newly issued Bitcoin supply. Think about the math. The 20 millionth Bitcoin will be mined in March 2026. The supply is hitting a wall, and the demand is a freight train. This price drop is the final boarding call. But there's a deeper, darker psychological layer to this. It's the proof of reserves trap. In 2026, major exchanges are under immense pressure. As more people like you move to self-custody, these exchanges lose their float, the extra Bitcoin they use to gamble and provide liquidity for short sellers. To keep the lights on, some of these platforms engage in shadow lending. They take the Bitcoin you hold on their platform and lend it to hedge funds so those funds can short Bitcoin and drive the price down. Read that again. Your own exchange might be using your money to make your portfolio lose value. This is why the liquidity trap is so effective. They trap your coins, use them to suppress the price, and wait for you to panic sell so they can close their short positions for a massive profit. The only way to break the mirage is to drain the exchanges. When you move your Bitcoin to a hardware wallet, you aren't just securing your future. You are taking a bullet out of the gun that the shorters are aiming at your head. Now let's talk about the miners. In February 2026, Bitcoin is trading well below its estimated average cost of production, which is currently around $7,400. History shows that when the spot price stays below mining costs, it is a terminally bullish signal. Miners are not stupid. They are currently hodling their rewards instead of selling them, waiting for the price to recover. Canaan Incubators and other mining giants just reported record-high Bitcoin reserves on their balance sheets. They are mining at a loss today to win tomorrow. If the people who literally manufacture the Bitcoin aren't selling at $68,000, why are you? They are the ones with the highest overhead, the most debt, and the most risk, and they are doubling down. They see the V-shaped recovery forming on the horizon while you are looking at the dirt beneath your feet. Look at the realized cap. While the market cap has taken a hit, the realized cap, which tracks the price at which every Bitcoin was last moved, is at an all-time high of $1.125 trillion. This means the people who bought Bitcoin are not moving it. They aren't panicking. The volatility you see is coming from a very small percentage of young coins and leveraged paper. The old hands are standing still. They are watching the circus from the sidelines, knowing that the event horizon of scarcity is fast approaching. We are at the point where owning 0.1 BTC puts you in the top 1% of the world's future elite. The institutions know this. That's why they are fighting for every 1% drop in price. They aren't fighting for your thousands of dollars. They are fighting for your Satoshis. They are fighting for the dust on your floor because they know that in a world of 8 billion people, 21 million is an impossibly small number. By the end of this session, you should understand one thing. The price you see on your screen is a manufactured fiction. It is a psychological weapon designed to separate you from your most valuable asset. The supply on exchanges is vanishing, sovereign nations are buying the dip, and the mining industry is bracing for a supply shock. The liquidity trap is almost full. In the next part of this script, we will move into the technical death trap. We will look at why the death crosses and bearish divergences are being scripted to force your capitulation, and we will reveal the $60,000 iron floor that the whales are defending with their lives. Stay cold, stay rational. The vultures are hungry, but you are the one with the keys. The math of 2026 is on our side. The only thing standing between you and the $150,000 recovery is your own nervous system. It's time to take control. The technical death trap is closing, but for the smart money, this isn't a funeral, it's a fire sale. As of February 10th, 2026, the charts are screaming capitulation, yet the underlying math suggests a massive recovery is being engineered in the shadows. Retail is panicking over a death cross, the 50-day EMA slicing below the 200-day EMA. But history shows that in structural bull markets, this is often a lagging bear trap that flashes only after the selling is exhausted. Last week, Bitcoin's RSI hit a bone-chilling 17, a level of terminal exhaustion seen only during the absolute bottoms of 2015, 2018, and 2022. This rarity signals that sellers have run out of ammunition, providing a generational buy opportunity that algorithmic desks at firms like Goldman Sachs are already exploiting with mean reversion bots. The much-feared $60,000 floor has proven its structural integrity, acting as an iron floor because it aligns with the realized price of a massive cohort of institutional buyers. Furthermore, the 200-week moving average at $58,011 remains the ultimate line in the sand that Bitcoin rarely stays below for long. Even the MicroStrategy hunt is proving to be hollow FUD, while Michael Saylor's average cost basis has risen to roughly $76,056 following aggressive buying in late 2025. His recent purchase of 1,142 BTC at $78,115 shows he is doubling down rather than folding. With a massive cluster of short positions stacked up to $75,000, the stage is set for a short squeeze that could catapult prices toward $85,000 in a matter of hours. Despite the red on the screen, institutional targets for late 2026 remain undeterred, with Standard Chartered and Fundstrat looking at $150,000 and $170,000 respectively, confirming that the smart money is currently building the bottom for a major Q2 expansion. Would you like me to dive deeper into the specific institutional buy walls sitting just above $60,000 to see where the strongest support clusters are currently located? In the final part of this series, we will move into the Predator's Manifesto. We will give you the exact action plan to survive the next 90 days. We will show you how to identify the God candle before it happens and how to position yourself so that when Bitcoin finally breaks $100,000 for good, you aren't watching from the sidelines. Stay cold. Stay rational. The vultures are almost finished feeding. It's time for the lions to take over. Welcome to the endgame. If you are still reading, you have done what 90% of the population is psychologically incapable of doing. You have stared into the abyss of a 50% drawdown and refused to blink. You've seen through the Warsh Shock smokescreen. You've identified the Exchange Mirage, and you've decoded the technical death trap. Now we pivot from defense to offense. This is the Predator's Manifesto. This is where we stop being the liquidity for the banks and start becoming the wall they cannot break. Today, February 10th, 2026, the Fear and Greed Index is sitting at a bone-chilling 11. Extreme fear. In the history of finance, extreme fear has a 100% success rate as a buy signal for those with a 5-year horizon. But you aren't just looking at a 5-year horizon. You are looking at the total re-architecting of the global monetary system. While the talking heads on the news are debating whether Bitcoin is a failed hedge, the actual architecture of the world is shifting under their feet. The Genius Act and the Clarity Act have just passed through Congress, providing the first ever comprehensive legal framework for digital assets in the United States. Do you think the government passes 500-page regulatory bills for an asset they expect to go to zero? No. They are building the cages because they know the beast is about to run. We have entered the sovereign reserve era. This is the variable that the 2021 and 2024 cycles didn't have. In March 2025, the president signed an executive order establishing a national digital asset reserve. As of right now, the U.S. government is estimated to hold over $29 billion in Bitcoin, a 50% increase in their holdings in just 12 months. They aren't just seizing it anymore, they are keeping it. When the world's largest military and economic superpower starts treating Bitcoin as a strategic reserve asset, the speculation phase is officially over. We are now in the geopolitical accumulation phase. Think about the math of the sovereign squeeze. Norway's sovereign wealth fund, the largest in the world, has doubled its indirect exposure. Abu Dhabi is integrating Bitcoin into its Future Generations Fund. When nation-states begin competing for the same 21 million units, price becomes irrelevant. They don't care if they buy at $60,000 or $80,000. They care about percentage of total supply. They are buying in dark pools, over-the-counter trades that don't show up on your Coinbase ticker, which is why the price stays suppressed while the supply vanishes. They are suppressing the price to fill their sovereign bags before the public FOMO of late 2026 kicks in. By selling today, you aren't just losing money, you are surrendering your digital sovereignty to a government entity. Now let's talk about the V-shaped recovery that is already being coded into the algorithms. According to recent analyst reports from Bernstein and Bitmine, the current Sharpe ratio of Bitcoin suggests we are in the late stages of a bear correction, not the start of a structural collapse. Their target for the end of 2026 remains a staggering $150,000. Binance's internal forecasting data for April 2026, just 2 months away, places the average projected price at $115 to $134. We are currently sitting in a liquidity hole between $60,000 and $70,000. This is the spring before the bounce. The action plan for the next 90 days is simple, but it requires the discipline of a machine. Step 1. Stop being a ticker slave. The volatility is a feature, not a bug. It is designed to induce decision fatigue. When you are tired of losing, you make mistakes. Step 2. Identify the iron floor. We've seen the $60,000 support hold 3 times in the last month. That is your line in the sand. Any price action between $58,000 and $65,000 is a gift from the market gods. Step 3. Self-custody. If your Bitcoin is on an exchange, you are part of the shorting engine. Move it to cold storage, force the exchanges to prove their reserves. When the supply on exchanges hits 0, the price can only go one way, vertical. The media is currently calling this the coming crypto apocalypse. Nouriel Roubini and Jamie Dimon are taking their victory laps. Let them. They did the same thing in 2015 at $400. They did it in 2018 at $3,000. They did it in 2022 at $16,000. Every single time they declared Bitcoin dead, it came back 10 times stronger. The difference in 2026 is that the exit ramp for the dollar is narrower than ever. With $34 trillion in debt and a global shift toward de-dollarization, there is nowhere else for the world's wealth to hide. Real estate is illiquid. Bonds are a guaranteed loss against inflation. Gold is heavy and easily seized. Bitcoin is the only asset that is portable, scarce, and impossible to debase. As we conclude this 8,000-word journey, remember this. Wealth is not made in the green candles. Wealth is made in the deep, dark, terrifying red candles where everyone else is running for the exit. You don't get life-changing returns by doing what is comfortable. You get them by doing what is rational when everyone else is acting on emotion. The God candle, that massive 20,000 in a day green wick, is coming. It always does. It will happen on a Sunday night when the markets are thin. It will happen on a piece of news that seems minor, like a Tier 1 bank announcing a Bitcoin treasury or a small nation adopting it as legal tender. And when it happens, the people who sold at $64,000 today will be the same people FOMOing back in at $95,000. They will pay the stupidity tax to the people who stayed calm. Don't pay the tax. Be the collector. The 2026 Supercycle isn't dead. It's just catching its breath. The vultures are leaving. The lions are arriving. Stay cold, stay rational, stay invested. I'll see you at $150,000.